if one of Wall Street's top stock analysts, someone who had a front row seat during the wild and woolly 90s, rubbing shoulders with the top CEOs, merger and acquisition bankers, and big gun investors, what if he decided to expose the world to everything he saw and heard? Well, that's just happened with the release of a new book, Confessions of a Wall Street Analyst. I'm Sarah Bartlett, and those revelations are our topic today on USA Inc. Joining us today are Dan Reingold, former star Wall Street analyst, and his niece and co-author, Jennifer Reingold, a senior writer at Fast Company magazine. Dan and Jennifer, thanks for being here.
Thanks for having us.
Your book is really interesting. Can you tell me what you think some of the big messages of the book are?
Well, I think the biggest message is that a lot of what went on in the 90s and in the bubble on Wall Street has not been exposed yet, particularly leakage of inside information. And a lot about the pressures on analysts. A lot of that has come out, but not all of it.
If you're a retail investor and you get an analyst report in the mail, what should one think about it?
Well, first, to start with skepticism. I think everyone knows that now. I think second, if you're willing to read the whole thing and look for all the details, you try to learn as much as you can about the industry and the company. You should read a lot of reports, not just one. You should try to use a lot of sources and not just Wall Street sources.
So you don't feel that they're completely tainted and should be thrown in the bin?
There's a lot of good analysis out there. There's a lot of good, honest analysts out there. But you don't know which ones. And it's hard to discern. You can't tell which firms or which analysts are thinking about corporate investment banking clients more than they are investor clients, and it's hard to tell.
Any thoughts about the big message of the book from your standpoint?
I think something that really has to come out is the idea that what happens on Wall Street is an insider's game. Essentially, there are rules, there are discussions, there are happenings on Wall Street that are not necessarily illegal, but that are things that you as an individual investor will never hear about until it's over. There will be money made, lost, stocks bought and sold. This happens long before you've heard of it. And the message here is to really be aware of that before you leap into the market.
One of the most riveting scenes for me in the book is a meeting with the Global Crossing executives. Can you just tell the audience a little bit about that?
It was an interesting meeting. It took place in June of 2001. And things were, no one knew it yet, but things were starting to get soft and difficult in the telecom industry, especially for companies like Global Crossing. Regulation FD, fair disclosure, that the SEC passed a year earlier, which required that companies disclose all new information, all new forecasts to the public all at once, and no selective disclosure had occurred earlier. In this meeting, attended by 17 of my guests, mostly hedge fund analysts and managers, the CEO of Global Crossing talked hypothetically about a change in strategy and a change in pricing of their services, which was interpreted by the participants in the meeting as a negative signal, as that something must be wrong.
That if he was even asking a hypothetical question like this, it must signal something larger.
Well, it was hypothetical. The people in the room were smart investors, but also a lot of them knew a lot about the telecom industry, knew a lot about what the competitors to Global Crossing were doing.
And knew this was a possible outcome.
Sure, and he was seeking to discuss, what's going to happen in the future in the industry. Could have been an innocent question and an innocent discussion. Within an hour of that statement, the stock was down 17%. Not a soul in the room had moved.
Well, they'd moved a little bit, right?
Their BlackBerries were very active. Their phones were very active, sending messages back to their trading desks. And that's no one else in the world knew. CNBC didn't know. The press didn't know. There were no public announcements. Even my own colleagues, my own team members who weren't in that meeting, and my own salespeople back at CSFB had no idea, because I didn't BlackBerry it to anybody. I have an obligation to send out information to everybody all at once, so I've got to collect my thoughts, I've got to do more research, and I do it all that evening after the meeting. Meanwhile, stock's down 17%.
So that's a great example of how it's not even just the little guy versus the big guns, it's certain big guns versus the rest of the world. I mean, if you're a hedge fund manager and you're in that meeting and you sell your stock before everybody else gets an opportunity to, you have a huge advantage. Now, is that insider trading?
It's a good question. I'm not a lawyer. I don't know. But because it took place in a group meeting, and the recipients of the information were not insiders. They had not signed confidentiality agreements. They were not inside as an advisor like a lawyer might be or an investment banker might be. My sense is that the law wouldn't treat it as that they were insiders or that they had received information in a fiduciary role.
So
on the other hand, you know something's amiss here, right?
Fundamentally, it's unfair is what it is. On the other hand, that is how analysts get their information. Their job is to meet with executives of public companies, talk to them, do financial analysis, but have the kind of conversations that allow them to learn something other people don't know. That's how they get ahead. So the question may not hinge on whether or not it's illegal. The question is really, is it fair?
And from what you're saying, you don't think it is, but it almost sounds like you're indicting the profession of analysis because their whole job is unfair in a way.
Well, as a journalist, it's also my job to try to get information before other people do, information that may not be something that companies want to have published and that may have a huge impact on a company's stock price. I still do it. Is that fair?
But you're not trading on that information, and you're not helping other people trade on it. You're disseminating it publicly.
That's true. That's true, but perhaps it appears in my publication before somebody else's. I mean, I think the idea is that the concept that information flows evenly and fairly is probably not a concept that any of us should cling to.
So
we come to a conclusion at the end of the book, giving advice to individual investors, and Jennifer referred to this before. Don't think that when you hear information, somebody says, let me give you a tip, or let me tell you something that I heard in the markets. Don't think you're the first or the 10th or even the 1,000th person to hear that. You're probably the millionth person to hear it, and therefore you're going to be buying and selling a stock that already reflects that information. So our conclusion is, don't try, if you're an individual or even if you're a professional but you're not in this sort of inside club, and you're not going to be in it very often. You may be in it once in a while, but most of the time it's going to work against you. Don't try to be a stock picker. Don't try to outsmart the market. Diversify well, buy index funds, things like that. It's a conclusion that says the markets have integrity issues, they have fairness issues. The integrity issues are sometimes issues of illegality and insider information leakage. The Global Crossing example doesn't fit that, but other examples in our book do. And that's our advice to individual investors.
Stay away from individual stocks.
Don't try to outsmart the market and pick stocks. You're going to be late to the game, and that means the stock already reflects that particular piece of information.
Now, aren't the regulators supposed to make it safe for small investors to pick individual stocks? Isn't that sort of the point, that there's going to be a level playing field? I can't remember how many times I've heard an SEC chairman assure me as an individual investor that there is a level playing field.
Well, the trick is to get inside information, illegally disclosed inside information out of the markets, to really, and this is one of our recommendations at the end of the book, to vigorously prosecute insider information leaks, both the tippers and the tippees, the recipients of the information, and we think they should be doing a lot more, looking a lot more at corporate executives, Wall Streeters, bankers, analysts, et cetera, who are not aware of and perhaps trafficking in this information.
That's one of the central contentions of your book, that there's this large sort of insider trading activity going on, whereas we've all been focusing on conflicts of interest and corporate governance issues. Why do you think it's so widespread, and how could the regulators not have known about this?
Well, that's an interesting question. I don't really know. I think that when Elliot Spitzer started to expose the conflicts of interest that are inherent on Wall Street, and particularly the conflict between the banker and the analyst, and between the banker's client and the analyst's client, the investor. He came up with so much interesting and inflammatory and embarrassing evidence, the emails that we all know about, that sort of became the story. And they didn't go a step further. There's actually two steps they didn't take, and they sort of called off the dogs on this. But one was to try to figure out whether the pressures for bullish research from analysts were not just coming from bankers, but were coming from the top of the firms. They started to go after Sandy Weil, and then they sort of cut back and cut that off and settled the whole case. It would have been nice to know, not just at Citigroup, but at all the firms, to what extent the executive suites were actually pressuring for analysts to change their opinions to be more bullish.
What's your theory about that? I mean, you had a front row seat.
My theory is it's both. I mean, I had a front row seat where not a single CEO or senior executive in any of the three firms I work for ever asked me to take a fresh look at a stock or to alter a view, or even really brought up my view. It was considered, don't mess with the analysts, let them be independent. On the other hand, who knows? Maybe the guy down the hall from me received pressure. I don't know, and I don't have evidence of that to point to. But we do know that Sandy Weil asked for a fresh look. That's a subtle question. It's not clear whether it's legal or illegal or a conflict or not. But maybe if they had really mined the files and deposed a lot of people at the upper levels of Citigroup, they would have found something more.
If I'm a regulator, I can't think of anything that would sear me in the public's mind more than going after a senior executive or a CEO. Why would they not go after somebody like that? What's your theory?
Well, it's a question that would be very nice to ask Eliot Spitzer, but he's running right now for governor, so it's probably hard to ask. I would agree with you totally that I think the deterrent power of that and having your name linked with something as Rudy Giuliani was in the 80s, is something that you would probably want to have as your legacy. I would also suggest that Eliot Spitzer probably feels very comfortable with his legacy in that he has created incredible change, not only on Wall Street, but in many other industries as well. So perhaps he has made things happen.
But that's one of the interesting parts of your book, though, is that I think many of us sit there and go, well, there's been a lot of reforms. There's been a lot of good change that's occurred. And yet your contention is that things are still bad and there's something flawed with the system.
Well, let me clarify that a little bit. We think that today the banking business and the analyst role live in a fishbowl. They're watched very carefully and they're on best behavior. But the inherent conflicts of an investment bank serving corporate clients who want to issue stock at the highest price possible and want to entertain mergers and acquisitions with the most support and highest stock prices possible against the interest of the investor who at base wants to buy stocks as cheap as possible and make the most money on those stocks. Those are conflicting interests. The analyst's job is to advise the investor and to give him the best possible advice as to what to do with the stocks. However, they're paid mostly out of pools of money that are generated from other parts of the firm, banking, trading, etc. And therefore, those who pay those fees into the bonus pool that goes to analysts and the research departments keep pressuring for, and so when this fishbowl, the lights go off, things could come back out. The reforms don't take away the financial connection between between other departments and the research analysts and the research department's budgets.
We'll explore that more in a minute. We'll be right back.
The Zicklin School of Business at Baruch College of the City University of New York is the largest and most diverse accredited business school in the United States, offering high-quality, full-time and part-time degree programs at the undergraduate, master's, and PhD levels. For information about the Zicklin School of Business, please visit our website, zicklin.baruch.cuny.edu. That's zicklin.baruch.cuny.edu.
Welcome back. I'm speaking with Dan Reingold, former star Wall Street analyst, and Jennifer Reingold, a senior writer at Fast Company magazine and co-authors of Confessions of Wall Street Analyst. You knew that the structure of the industry was flawed at a certain point. It became clear to you how troubling this system was. Did it ever occur to you to pick up the phone and call a regulator or try to impose some order on this chaos yourself?
Yeah. I mean, this wasn't a secret. A lot of people on the street, executives and analysts and bankers at many firms, became aware and concerned about what was happening because it created competitive advantages for one firm or one analyst or one banker versus another. but usually the next day you'd wake up and read an article in the Wall Street Journal or some other publication indicating that or making the public aware that there were issues both with regard to analyst conflict and analyst-banker information flow and potentially information flow out to the investor community that could have been insider trading, and certainly raised issues of conflict of interest amongst analysts in their recommendations. So that's kind of how I looked at it. Like every time I thought it's time to blow the whistle had already blown. It was sort of out there. Now, when I look back on it, and you kind of see a pattern develop over an 8-year period or so, and you look back, you kind of hit yourself and say, you know, even though you thought a lot of people knew, you thought a lot of the press knew, you thought that the SEC officials were reading the press. I mean, they certainly read the Wall Street Journal, the New York Times, other publications like that. It probably would have been the right thing to do to just highlight it even further. There's even an article in 1997, this goes back quite a ways, in the Wall Street Journal, wherein the Director of Enforcement at the SEC is quoted with regard to analyst conflicts of interest as saying, well, you know, we don't really know what's legal and what's illegal in this arena. And this is after the article has exposed the whole issue and raised the whole issue. So you kind of think, geez, you know, the SEC knows. Hopefully they're doing something about it. We had heard there was a big file being carried on Grubman, for example, and watching him. The compliance department at Salomon Brothers was watching him and investigating how his reports were going out and what was being said.
Well, that's probably the most controversial part of your book, is that you do really go after Jack Grubman at Salomon Brothers and the sort of rival telecom analyst. And in many cases, you seem to feel that he has been involved in insider trading situations, and yet, as you put it, I think crime seems to pay. He doesn't have to forfeit the gains from that. He enhances his role as an analyst through that. If that was so troublesome to you, as it seems to have been in the book, again, you know, why not pick up the phone? Why not blow the whistle on him?
Well, let's be careful. In the book, we made clear, and in my mind at the time these things were happening, the question of illegal or not illegal activity is ambiguous.
In each instance?
In each instance, because the question is not whether information that was not yet public was being moved from, let's say, an analyst over to an institutional investor, but whether that information had been obtained while over the wall, while the analyst was a fiduciary, was an advisor, was an insider to a particular company. That is information that, as we talk about in the book, is not known to me. I don't know, I didn't know then, I don't know now, whether he was breaking the law. If you want to talk about about Jack Grubman. I don't know that. And that's important because it's this ambiguity that creates an issue even for the investor who receives the information. Is he trading on insider information or is he not? When you look back and you see a pattern, you might come to conclusions. And a prosecutor might come to conclusions and a jury might come to conclusions. But we don't know. That was never raised as an issue in any of the investigations.
And I think there's another issue here when it comes to Jack Grubman in particular. He was such a loud cheerleader for what he was doing, and everything he did, he was not only unapologetic about it, but in fact trumpeting that the way he was doing business and his close interactions with bankers and being on the inside of the deal was the way to win. So I think that is another part of the complexity of this story, is that he said it, people listen to him, and people start to wonder, well, is this the right way to conduct business? And am I an old fogey for thinking there's something wrong or possibly illegal about it? Am I the one who's wrong, or is he the one? And I think he used that very successfully to his advantage.
You know, you really have to give, I mean, we do criticize Elliot Spitzer for not having gone far enough on several issues. And not taking, for example, a few analysts to court to determine whether are our laws strong enough? Maybe they did this, but maybe it's actually not a securities fraud to do it. You know, and if that's the case, we probably should rewrite the laws and make them stronger. But credit to Elliot Spitzer is that he raised the issues, and he made it obvious. What that SEC enforcement official said was, well, we don't know if it's legal or illegal. Well, Elliot Spitzer just plain out showed by showing some of these emails. See how obviously wrong this is? See how obviously sort of dishonest the advice that investors are getting? It became obvious once he publicized it.
So that the
legality, you got to give him credit for kind of pulling everybody out of the muck and saying, you know what, there really is black and white here. It's not gray.
And so perhaps the shame is that it didn't go further, that it was so focused on the conflicts.
Right, because you want, if there's something that's wrong and illegal, you want punishments that show all of the rest of us enough, or create enough fear that deters us from doing what those other people did.
And you don't.
And I don't think so. No, that's why we do say that we think crime sort of pays, because who really was taken to the cleaners on this? I mean, a couple corporate executives have, but on the Wall Street side, I really don't think so.
And no analysts have really suffered gravely.
Not really, not that I'm aware of.
Now, you contend in your book that you made analytical mistakes when you look back at your career, but it certainly comes across as if every time you were tempted to be kind of on the wayward path, getting a little extra money for something that's a little questionable, that you always said no. Is that really, do you ever feel like you did anything other than make some analytical mistakes?
I think I made some big analytical mistakes.
But in terms of being tempted to do the wrong thing, the book implies you never did the wrong thing.
Right.
How did you avoid the temptation? I mean, all around you, there's millions of dollars being...
It helps to have good advisors around you. I mean, my wife and I have discussed every big decision I made. I was offered a contract at CSFB that offered me a percentage, an explicit percentage of the investment banking fees that they earned. You know, I had an opportunity to say yes to that or no to that. And on a quick consultation with my moral compass, my wife, it was so obvious that, you know, don't take it, just don't.
So the moral of the story is have a great spouse. Right?
Well, I mean, you need someone to bounce things off of, because sometimes in the heat of battle and in the heat of your career and competition and ambition and everything else, you lose sight of it. So that's key. I think the other thing, though, I mean, I talk a lot in the book about some stock picks, AT&T, for example, Quest, for example, where I clearly stayed bullish too long or bought into the bull story, you know, believed that somehow they would be better than the other companies or perform better, and they didn't in the end. And Quest turned out to have been fraudulent in its accounting. AT&T turned out to have been so debt laden that they couldn't get out of their own way and had to split up the company. But when you're there and you're living in an environment, what Alan Greenspan called irrational exuberance, and you say, yeah, okay, maybe things are too bullish, but maybe some of these things are going to work out, and you get a little bit of the fever. And I'm not trying to say in the book, or have I ever said that I was so skeptical and so smart that I saw through all the bull. I didn't. I was part of some of that bullish cycle. Sometimes you believe some of the hype around you. Sometimes there is empirical evidence, and in a fraudulent company, the evidence is actually there. You just got to figure out that it's fraudulent. If you don't, you say, wow, these numbers are overpowering. That's what happened at Quest. It happened to some analysts on WorldCom. It happened a little bit at Global Crossing, because they had some accounting restatements they had to do.
This is an unusual situation, because you have basically you were on the front row of this period, and now you're going public with your most many what I would call sort of secrets of the industry. Have you had any reaction from Wall Street? Are you going to become a pariah? You're going to flee to some island somewhere and hide?
Well, we'll see.
What's your sense?
Well, number one, I think you don't see other people writing this kind of book, because most people who observe this are probably younger than me, still in the markets, still want to maintain their careers. I'm lucky enough that I was able to walk away from it, and I don't think I deserve any special credit for writing this book, because...
Maybe Jennifer.
Jennifer deserves a lot of special credit for writing this book.
But I didn't have to walk away from Wall Street, so...
But, I mean, no one on Wall Street's ever going to hire me again, and it's not clear that anyone would hire me again, because who wants a whistleblower? Who wants a guy who 5 years later is going to tell stories about people that whoever wants to even talk to people are very careful now when they talk to me. I said, don't worry, I'm not going to write another book.
You live in the world of finance. What do you think? Do you think he's going to be a pariah?
I think it will be very interesting to see the reactions that we've had thus far with people who are former colleagues and so forth have been very positive, very thank you for doing this. Thank you for exposing some things that we all have known for a long time. I'm certain that there will be many people who are not happy with their portrayal in the book or will perhaps take issue with some of the facts. That's to be expected in any kind of a whistleblowing type book. And there's always pressure put upon the writer of a book like this. People will question why he's doing it, what his motivations are. It's clearly not a financial motive in this case, and I think that really helps Dan. He just wanted to tell this story and to make it clear to people and hopefully to teach investors and people who might consider being on the street or anyone really that there are other paths to follow.
Yeah, what's your last little bit of advice for an individual investor?
Buy index funds. Be careful of what you hear. Don't think you can outsmart the market. Certainly don't be a day trader, and maybe not even a weekly trader.
Okay. I've been fortunate to have Dan Reingold and Jennifer Reingold, co-authors of Confessions of a Wall Street Analyst, as my guests. Thank you, Dan and Jennifer, for being on the show. We'll be right back.
Some people think of New York as the world's second home. The City University of New York, with students coming from 90 countries and speaking more than 155 languages, is the world's first university. Find us on the web at cuny.edu or call us at 1-800-CUNY-YES.
One of the bedrock principles of our economy is that the stock market is an efficient arbiter of capital. The theory is that if we all have the same information and place our bets, the prices of those stocks that deserve to do well will rise, and the prices of those that don't will fall. But that system only works if the underlying premise is correct, that no one is trading on inside information that the rest of us aren't privy to. The SEC is supposed to police the system. As the Reingold's book makes clear, that is not the case. Illegal activities are still rampant on Wall Street, and none of the regulatory fixes that have been put in place have really changed anything. So where does that leave an individual investor? It leaves us in the world of mutual funds, which of course aren't immune from corruption either. What's the safest bet? Mutual funds that offer the smallest opportunity for a human being to have any influence. That means broad-based funds that essentially replicate a stock market index like the Standard & Poor's 500. Thankfully, a computer can do that. For USA Inc., I'm Sarah Bartlett.